Hello traders, welcome back to another video in this trading diary. So today we're going to go through a very common situation for many traders, something called FOMO, which I'm sure you're aware of, the fear of missing out, and how to miss a trade and still profit in the market. So no more worrying about missing out on your setups. How are we going to get rid of the fear of missing out? Well, we're going to do that by realizing that there is always another opportunity and you can still make money from the move in the market which you have already anticipated. So what to do if you miss a trade? Well, first thing is never chase the market. It's always going to come to you. Second thing is be like water, as Bruce Lee said, adapt to what's happening. It may not always be so obvious, and you can always see another opportunity if you let go of the need to trade every single move that you see and every single move that you've missed, thinking that this is the only move that's available. Also, remember, markets are fractal, so you can use multiple time frames to find the next best entry, and we're going to go through that right now and see how to do that. So let's go through the way to make the most of your setup even if you missed it. Okay, so the concept of entering a trade after you've missed it is very simple. Let's say you have the time frame that you analyze your chart and you take your setups on. Let's say, for example, that is the daily. You have a market that's trending if you're a trend trader, and then you have an entry for whatever reason. Let's say it's a fib, and you have a level, you have a confluence, and you have a retracement perhaps to the EMA, and you decide to take a short. However, you've come to your chart and then the market has moved a significant number of pips or points in that direction, and you have now got a very large stop loss and you are effectively too late. So what to do in this case? Well, what you can do is you can still make the most of this move. The move which you expected on the daily, which you anticipated, and which you've correctly identified, is happening on the daily, and you expect the market to move in your direction, perhaps to the next significant level. Well, what can you do at that point? At that point, you can look for a smaller time frame, a lower time frame entry where the market retraces into another entry, and then you can take that continuation. So perhaps you haven't got in at the highest point, but you can get in at the next highest in exactly the same move as part of this larger daily picture. So within this larger daily picture, you will have swings in the market where if you missed the first one, you can take the next one and the next one after that. So to do that, you will need to apply the same principles, the same rules, but on a lower time frame. So if it's on a daily that you usually trade, you can apply the rule to the 1 hour and make the most of it later on and wait for the market to come to you, to your entry and within your rules. So perhaps you will not take the entirety of this move, but you will still be able to take a portion of it, and you will still be able to make a profit based on the time frame when you go up or down, long or short. So effectively what we're talking about here is a move within a move. So we have the larger picture structure, and within that structure we have a mini structure inside this whole move with the same rules, and in this case it will be a pullback, could be an EMA again, or the fib, and we can still make money when we go down. So now let's look at what that looks like on a chart. As an example, we'll go to our Olymp Trade platform, and here we have the Euro Aussie on the daily chart. We can add our indicators that perhaps we've used. Let's say here we have a level, perhaps we also have some oscillators, RSI, stochastic, that indicates to us where to enter the trade. So perhaps we have this area here. Let's say that this is where we prepare to go short, and let us say that we've identified our rules are matching on across all our indicators. So in this case perhaps the stochastic crossed, and we have an RSI going down, and perhaps we also have some price action, and we decide to go down to sell. So let's say that in this occasion what's happened, the market has moved off and we are now too late. We wanted to enter at this time, but in fact the market has now continued on its movement down and we are now too late. So what do? We can anticipate a pullback and retracement on the lower time frame. So let's just remove these indicators for a moment. And now what do we expect? We expect a retracement in the market within the same parameters as we've already had before, but on a lower time frame. So we don't know where that pullback, where that retracement will come to, but we do know that it will happen at some point, and when that happens then we will take our entry. So what we do is we just go into the lower time frame, in this case the 1 hour, and our entry was, let's mark it out, was here, ideal entry. Now we are waiting for that pullback, and we can see that that pullback is happening. Now if we bring back the indicators, and let's say for example we had our indicators and we also had the same rules applying, where we had a crossover on a stochastic and we have a lower low on the RSI that indicate a continuation, a move down, and therefore this would be where we now sell. So this is where we expect the market to continue, and therefore we sell from here. It may not be the very top where we expected to earlier, but we also have again the next best entry, and in this case on the lower time frame on the 1 hour, and it's still a valid entry. And as you can see, after the pullback we can expect markets to continue. Perhaps you also had, let's say part of your rules were Fibonacci, so we can draw the level, and in this case it went past the 61 into the 76. So that is a very simple, easy way to look into the lower time frames and not have the FOMO that traders often experience. And here is a guideline for the time frames that you can use. So if this column here represents the higher time frame that you usually use, these are the lower time frames where you can have the pullback or retracement or lower time frame entry. So you can combine the daily with the 1 hour, the 4 hour with the 30 minutes, the 1 hour with the 5 minutes, and the 15 minute with the 1 minute, depending on the time frames that you choose to trade and go up or down to buy or sell. So use those in combination and you will have a very calm and peaceful trading experience. So lastly, let's just have a look here at how it looks like on the daily chart, where we expected that pullback entry to be. So we had our entry here, and in fact the market pulled back and we had just about the same entry, a little bit lower, and the market continued on its way and it's currently in that direction. So as you can see, if you zoom back out, you will see that picture in a little bit cleaner format, a little bit easier to see, and we can go back down into the 1 hour. And we can see there's a little bit of a ranging movement before the market decided that it was time to head down. So that is how you can combine both of them and not miss out on moves, still make the most of the market. And if you do miss your trade, if you do miss your ideal setup, you will have another opportunity. The market doesn't always give you another opportunity. Sometimes it does head down, but if it does, you just simply leave it be and not trade, not take the risk. So the market may have gone straight down like this instead of retracing, and that's fine. That would be a setup to leave alone. However, most of the time we do have pullbacks and retracements. The market does create swings, and quite often you'll be able to make the most of it if you keep an eye on your setup. So good luck in your trading, and see you on the next video.